Why can frequent checking be harmful? The concept of loss aversion, introduced by Nobel Prize winning behavioral economists Daniel Kahneman and Amos Tversky, states, people feel the pain of a loss about twice as strongly as the pleasure of an equivalent gain. What does this mean in practice? Daily checking equals seeing more micro losses. More perceived losses equals more stress. More stress equals more poor decisions. This effect is known in the literature as myopic loss aversion. Exposure to short-term fluctuations makes long-term investors unnecessarily defensive. What does the research say? Barber and Odeen studies. Research by Brad Barber and Terence Odeen on investor behavior found that investors who trade more frequently, investors who check their portfolios more often, earned lower average returns. Why? Overconfidence, higher transaction costs, emotional reactions. Vanguard and passive investing data. Long-term analyses by Vanguard show markets are volatile in the short term. Markets trend upward in the long term. Historically, on a daily basis, markets frequently decline. Over 10-plus-year periods, markets have mostly produced positive returns. If you look daily, you see chaos. If you look at a 10-year chart, you see growth. Is checking once a week enough? The answer depends on your investing style. If you are a long-term passive investor, index funds, broad diversification, regular contributions, 5, 10-plus-year horizon, checking once a week is more than enough. Even once a month is often sufficient, because daily data does not improve decision quality. It only increases emotional volatility. If you are an active trader, short-term trades, technical analysis, daily/weekly positions, once a week is not enough. But this is trading, not investing. The risk and stress levels are much higher. The psychological effects of frequent checking. Frequent monitoring leads to constant comparison, fear of missing out (FOMO), panic selling, selling during declines, buying late during rises. This produces the greatest enemy of investing: behavioral mistakes. Many studies show that investors' biggest losses are caused not by picking the wrong stock, but by poor timing. The mathematical reality. Short-term probability. Probability of a one-day decline is almost equal to 45 to 50%. Long-term probability. Probability of positive returns over 10 years is almost equal to historically much higher. The more often you check, the more likely you are to see negative outcomes. The more likely your morale drops. The more likely you intervene incorrectly. Advantages of checking once a week. Creates emotional distance. Reduces transaction costs. Increases discipline. Supports long-term thinking. Reduces the illusion of control. Investing is mostly patience plus system plus repetition. The real question: is checking once a week enough? The better question is, does checking more often increase my returns? Most of the time, the answer is no. What do professionals do? Large fund managers set strategy, diversify risk, maintain discipline, but they don't stare at charts every minute. Warren Buffett's famous approach: our favorite holding period is forever. This mindset makes weekly checks sufficient, makes daily checks unnecessary. Conclusion: for long-term investors, checking once a week is sufficient, often more than enough. For active traders, it is insufficient, but risk is significantly higher. The most critical truth: returns are not increased by checking frequency, but by the quality of your behavior.